Well, welcome everybody. For those of you who don't know, my name is Joel, and the Cashbox team with us tonight is Andrew, who's going to be presenting, Chad, Logan, I think he's here as well, and then Devin, the new Kim. So you're going to get to know Devin well. So as always, first some housekeeping. Cashbox is authorized and regulated in both Mauritius and South Africa, and all of our disclosure information is available on our website. So the information that we provide is for education and to assist investors to make more informed decisions, and what we present shouldn't be regarded as advice or a recommendation. So tonight we are very excited to launch Thought Leadership Thursdays, things investors should know. On a daily basis, we get lots of different questions from our investor community relating to all things investing, not only our view on the market, our structured notes work, or for that matter, when the next note is coming out. Earlier this week, we were actually presenting to an investment coaching community in New Zealand. And right after the introduction, we were asked what the H is going on with the markets. What just happened? So we'd been toying with the idea of doing more informational webinars for a while now, and this was actually the catalyst. So the objective of Thought Leadership Thursdays, or TLT, as you'll get to know, is going to be to share things that investors should know. We are planning on having the sessions on the second Thursday of the month, unless we're presenting a new note. And the sessions are only going to be 30 minutes, and they're going to be on various topics, and we'll be answering your questions as well. And we will base it on questions being asked by our investors. We're also going to be inviting guest speakers to share their knowledge and insights with our community. So if there's anything in particular in terms of topics that you would like us to include, please let us know via the chat, or you can send me an email. And then if there are any questions that you have on the topic this evening in terms of what the H happened this last week, please pop them in the chat as well, and then Andrew will respond to them. We are going to be trying to stick to the 30 minutes so that people can plan around that. And so with that, we present the very first TLT session titled The Noise and the Storm. And Andrew,
there's some noise and storm right there.
Yeah, just mute everybody.
Right, hi everybody. From a very wet and wild, stormy Cape Town. It seems to have been like this for most of the month and winter, in fact. So it's storming and raining outside, and it's much better being in the office. So, yeah, the picture says it all. I think most of us, wherever we may be, when we woke up on Monday in various time zones, it was certainly a dark day for global stock markets and investors worldwide. I think that guy's perturbed face, and also what the heck just happened, was a great topic for us to launch this Thought Leadership Thursdays, given it happened this week, and it's still kind of unwinding itself as before the end of the week. So yeah, Jill, I'll tell you when we need to just advance the slide. Okay, so effectively, the pain, this is a quick overview, the pain in world global stock markets started in Asia, where Japan's Nikkei 225 lost more than 12%. It was its worst day since 1987. The South Korean Kospi, created sank over 8%. It actually forced midday a halt in the midday trades, which was quite unusual. And I think once we saw that dismal showing in Asia, the sell-off quickly turned global. Australia fell, Europe dropped, the UK dropped. In the US, close of business Monday, the Dow had dropped 1,000 points. It had never had such a steep decline in its history. S&P, the NASDAQ, everything was severely hit. All three major US indices are the bellwether that I watch. And I think, there were these mounting recession fears taking the blame for the collapse after a less than stellar sort of July jobs report. But we're going to get into some of those details in a while. So I'm just having a look here if I can just kill that quickly. So there were a number of root causes for what happened on Monday, and there were also some reinforced drivers, okay, that actually combined, and there's this new word floating around called confluence. It's like a confluence of rivers that effectively become a delta. that combined to create this global market mayhem on Monday. And I think what really happened was this confluence of events, all these events that we're going to go through, culminated and reached a head, if you want to call it that, forcing an absolute brutal shift in risk appetite. There were also, other factors, lofty, maybe unachievable earnings forecasts, surging volatility, the brewing Middle East conflict that led a whole lot of people for different reasons to start unwinding positions. But let's have a look at a few slides just to show you what has happened before we have a look at what caused that actual dark day, because things were happening before Monday that a lot of people don't actually reflect on. So if we can go to the next slide, Jill, which I think is of a chart.
Okay.
Okay, there you go. So these are just brief sort of stochastic graphs of terms of what happened. You can see on the right-hand side of this particular chart, you've got those three major developed markets indices, which just, as I use the word cratered, just went down a mine shaft, particularly the Japanese market, the S&P and the NASDAQ to a lesser degree. But, when you lose 12%, that was the Nikkei, it was pretty hectic. Safe to say, if you can make out the chart, you'll see on the far right-hand side the recovery. So Monday was dark, doom and gloom sort of bust day. And then the very next day, Tuesday, I know at one particular time it was up 10.5%. So it came sort of bouncing back up like a boomerang. And it was then what came up and didn't keep going down was that people suddenly realized there are reasonable explanations for what has happened to cause this mayhem. And we're going to address some of those reasons. So let's just nip into the next one then, Jill, the next slide, which is quite an interesting slide. So some of you may be familiar with what VIX stands for. It's a volatility index. It's got a much longer name, the Chicago Board of Exchange Volatility Index. It goes back to 2020. And you can see what happened in March 2020 when it just went rocketing up in March, when the pandemic fully hit and the implications of economic lockdowns and how we were going to change the way we lived, worked, and talked to each other happened. You can see it also came back very quickly. And if we cast our minds back to 2020, for the balance of 2020 after March, from about July, if certain sectors just roared ahead, mainly the tech sector, the digital sectors, etc. And since then, it's managed itself. You can see on the far right-hand side, again, we've had this sharp spike up, but nothing in comparison to what we experienced in 2020. But nonetheless, this was an unprecedented spike that literally came out of nowhere, but like the so-called bats that were in Wuhan that came out of nowhere. So safe to say that volatility index, it spiked on Monday at 68, it's down to less than 30. And 30 is quite an important measure. If it's below 30, we go into the sort of less fearful mode. If it's above 30, anything above 30, then you get extreme fear and absolute fear where people are just saying, this is really crazy. Now, this is based on a 30-day period in terms of derivative options, which is a gauge in terms of which way is the market sort of moving. It's not 100% accurate. In fact, this has got an accuracy rating from the University of Pennsylvania of about 20 to 25%. So like all statistics, there's text, lies, and damn statistics, and they're part of our lives. But again, it was a fear factor, and there was panic on Monday. And what I'm now going to do is take you into the sort of main reasons. And this is the bulk of the sort of presentation of what actually happened. Okay, so we can go to and I think this is my last slide. So it's a bullet point slide, if we can just go through there. Jill, if you can move along. Thanks.
Yeah, getting there.
Okay, so there's 5 points here. There's 5 major reasons, and there's a lot of anecdotal stuff around it, but I'm going to try and stick to my knitting in terms of describing. So earnings are the earnings of a company. It's corporate earnings in terms of how well is it doing. That's its health check in terms of, are we making money? Are we passing on revenue? And are we passing on profits to our shareholders and people who are interested in our business? And earnings have been actually strong this year. I think of the S&P 500, the companies that make up that have reported, I think it was about 70% have recorded their quarter 2 earnings thus far. And many of them have beaten the expectations that Wall Street sets them. This is very important, that word expects, okay? According to the Bank of America, 70% have reported. And the year-on-year has hit, I think, an impressive growth on the S&P itself. If you have to bet in that index or plan that index, is about 11 or 12%. So it's not a bad index to have chosen year-on-year. So if we had to go back 12 months. And earnings season, we call it a season. Every quarter is a season when you report the previous quarter's earnings, is surpassing expectations. There's that word again, okay? However, if you drill into what those beats are, those earnings beats, they generally, on average, are only winning or beating by around about 2%. Again, these are Bank of America statistics. So that's actually quite a small beat in terms of, I only beat my previous quarter by 2%, by 2%, by 2%. So it's not, some are obviously doing exceptionally better, but on average, you're looking at a 2% beat, which is not, it's not way passing those expectations. So one of the guys that I follow very closely is the chief marketing strategist at probably one of the biggest research companies in the world, 𝘗𝘕𝘂𝘃 Research. And he's got a very interesting, and his name's going to pop up again, 𝘗𝘕𝘂𝘃. His name's going to pop up in some of the other bullet points. In terms of this earnings season is surpassing expectations. So I think what's happening is, what I'm trying to say is, Wall Street has a greater expectation, and it may be too strong, hence the bullet point, for many companies to match. If you certainly don't beat the expectation, you generally find the share gets absolutely annihilated the next day, even though it's a quality company. So that's something quite, it's an expectations problem, not a growth problem, I think, which is interesting. And I think this comes about because what we have seen is longer term earnings forecasts have simply become too high amid especially the current AI hype. And finally, I guess what's happened is it's time to pay the piper as these valuations come down. Now, this is quite an interesting, because this has led to a reassessment of risk amongst investors on Wall Street. And when you combine this with falling stock market prices or company prices, it creates a negative feedback loop back into those markets. So I'll tell you exactly what I'll put this in plain English. So when I worked on the stock market and with the investment banks, what functionally happens in a lot of asset management houses is that the risk manager on the 5th floor will come walking down to the portfolio manager or the traders on the bottom floor, and he'll say, we need to bring down the risk, chaps. It's got too high. Okay, our assessments of risk are that it's too up. Okay, you've got to bring it down. So the portfolio manager now starts to sell, and that then reinforces that feedback dynamic in terms of, well, he's been told to do something, so he does it. There's a point right at the end where there's a forced trigger that forces certain mandates to sell when an algorithm kicks in. It's like a stop-loss selling, and I'll talk about that a little bit later. Again, it feeds back into this negative dynamic of suddenly stocks being dumped, okay? And this feedback loop, this negative of saying the risk is too high, we need to start selling, started actually a few weeks ago in this particular quarter, okay? It started when many investors, because these high valuations, decided, well, we're actually now going to do what's called rotate. We're going to actually rotate out of the sector, or rotate out of our positions, let's say out of high tech, big tech, AI type of linked stocks, and let's move into smaller, let's say mid cap and small cap companies, capitalized companies, in anticipation of these interest rates that are going to come down. So this all happened last month, okay, at the end of July. So that was another feature of more stocks. So there's this big pool of stocks building up, people slowly starting to sell them down, okay? It's a few trigger events that are now going to come along. And I think there's been a bit of a bubble in terms of, I think these lofty valuations I talk about, companies being valued at perhaps a greater degree of wealth than that probably their earnings can actually support them at. And that's the traditional price earnings ratio. And I think this is part of an unwinding of this sort of bubble of risky assets, of which probably AI and tech are there, but they've done very, very well. We've had 2 years of probably in that space, 2 years of solid price appreciation, along with these expectations that it's just going to keep on going. Okay. I think also last week and this week, during all this chaos and pandemonium, we've had also some disappointing results from some of these big tech and AI-inspired companies. I'll give you one. Amazon is one of a very good example that springs to mind. It missed its actual second quarter revenue forecast and the expectations that goes with it. And it turned in a disappointing sort of lukewarm guidance for the balance of the year, saying, guys, growth is not going to be there at the rate that we've been experiencing. Things are cooling. Intel, we saw it happen to Intel. It got absolutely hammered. It missed its forecast. It slashed its dividend, and it fired 1,800 staff to try and contain costs. So again, there was a lot of negativity. Things were pretty gloomy before Monday came along. Okay, Monday was the trigger, but all this was happening in the background. So this is the next one. Recession fears are back in vogue. I think certainly a lot of people have put recession fears on the back burner after 2023. So we were all expecting interest rates to go down. A lot of people were expecting them to happen in March. It didn't happen. It didn't happen in July. Everybody's like forecasting that it's going to be happening in September, and we'll touch on that. And then we had this, the big recession was because they'd only added 114,000 jobs in July. These are all data statistics from the Bureau of Statistics in the States of Labor. And there was also, a bigger increase in the unemployment rate from 4.1 from 4.3. So all these added together, things are looking very gloomy. And they all said, like, hang on, this triggers a recession. A recessionary moves. The US economy is not in the state that we all thought it was, that Jerome Powell is being far too dovish. He got it wrong 3 years ago when he said, no, inflation is not sticky. It's going to be very transient. And look what happened there. They were slow to start their rate increases. And a lot of commentators now, the noise that the slide you saw, the noise is that, well, he's waiting too long. We need an emergency cut. We need to have 5 cuts in this year to bring it down to more to the Fed's funds rate of 2%, etc. So there's all this stuff going on. I mean, as I said, I mentioned this guy, 𝘗𝘰𝘷𝘪𝘐. It's very interesting. And his points make absolute sense, but they're in complete contradiction to the chief economist of Fidelity and Vanguard, which are two of the biggest, largest asset management companies in the world. Two respected marketplace commentators. So, Ed said the latter are saying we need rapid cuts, probably 2 or 3 this year, and not small, because of this. And then on the other hand, you've got guys saying, well, hang on, we're judging all this panic selling and the fact that we may be going into a recession on 1 month. 1 month is quite volatile. It's a short time period. Maybe we should look at the 3-month statistic, okay? And the 3-month statistic is very interesting because it takes the unemployment or the job creation level back to pre-pandemic times, end of 2019, early 2020. So we're going back to almost what was normal pre the pandemic, which changed everything. The other thing that's interesting about this is that some of the justification for saying rather look at 3 months and not 1 month, and it comes down to something quite arcane: the weather. The weather in July across the United States was very turbulent, and they're saying that the weather caused a lot of new job hires not to happen, especially in the seasonality of their summer. We would ordinarily take on more staff because of poor weather conditions. So rather look at the three-year picture. So it's quite interesting when you take a step back and you start looking and measuring, are we going flat out into recession because the Fed actually dithered and dallied? Or are there other reasons that we should actually say, hang on, let's just sit back and drill a little bit deeper? Okay, so moving along into the next one. We all know about this. The conflict in the Middle East is certainly testing. And over the weekend, there was assassinations last week in the Middle East, in Tehran, in Iran. And there's this ever-increasing potential of the broadening of the conflict, which also weighed on investors on Monday. There's all this bad news in terms of global geopolitical conflict. And it led to some more fear-based selling, which certainly doesn't help it. I mean, I was asked a question, in fact, this afternoon when we were having a break, about has the world markets sort of brushed off the Israeli-Gaza thing? But I don't think they have. But that is a very confined conflict in terms of what's going on there. When I say brushed off, I don't mean that lightly. It's just that markets are normally very sensitive to situations. But I think what happened on Monday with the bombing of the Hamas leader, or very senior political person there, it's suddenly now on Iranian soil. The Tehran government has said, we are going to respond. We are going to widen the conflict. And obviously, that's going to put a pressure of an economic force into oil. Okay. So oil is, at the moment, it's been quite resilient during this conflict that's been confined to the borders of Israel and internally. But this could be, something, it looks like there's a very real possibility that Israel and Iran could go to war. And that's a huge risk, which is increasing. And that also was on our plates on Monday morning to cough it up. Now, let's go to the next one. Now, this is the trigger that I spoke about. Watching my time very carefully. For years and years and years, while we were raising interest rates, Bank of Japan held their rates almost at zero. That's been their style. They've had painful deflation, so they didn't feel it was worth fighting. But the unintended consequence of this policy of having almost 0% was that there's a large interest rate differential between Western nations and Japan. So what does that mean? It means that foreign investors were pulled into something called the carry trade. Now, this is where I think greed sometimes comes in, and it's leverage. So this is what it actually means, is that an investor will borrow money in one currency with a low interest rate, hence the yen, and then invest that money back into other assets, often abroad outside of Japan, often US treasuries, or especially the big tech in the US and AI, something like that. So it was a very, very easy, very popular, and very effective way of getting exposure and paying nothing, basically using somebody else's money. You're not really paying anything for it. It was very, very easy, and it worked very, very well. And they work well until they don't. And they didn't on Monday, because the Bank of Japan unexpectedly went from 0.1% to 0.25. Okay. So, and everybody was in it. It's a massive, massive economic space, this carry trade space. Carries a lot of weight in it. I think there was something like $13 trillion in the space being carried. So super crowded. Everybody was overextended. And plenty of people were trying to catch up to doing this business by leverage to get quick exposure, and they didn't want to miss out on the gains. Greed was driving this. So suddenly they've raised the rate, which means that the guys have either got to put up the margin or they've got to close their positions, get out very quickly. So you literally had to get out, and that's what caused we're selling, we're closing the options, we're getting out. Traders, I heard from some colleagues that I work with and some of the investment banks, were selling positions in profit just to cover the positions that they were going to take a bath and a haircut on. So they just wanted to get out. So it was panic of second nature. It just came along, and everybody was in it. A little bit like I think a little bit like what happened in March 2020. So very, very similar to the to that scenario. So let's move on to the last one. This is something that hasn't been mentioned by a lot of, going really fast now. Let's just move on to the last bullet point there. This is something that hasn't been mentioned by a lot of the press. I mentioned it briefly. You have what's called volatility-induced selling. What does that mean? It means that you're forced to sell at a certain point. So we've got all these things adding together. Ongoing tech sell-off, war in the Middle East, economic slowdown potentially in the US, Wall Street's fear gauge that I mentioned, that VIX, all surged on Monday. But what also happened was, especially in the United States, there are a number of types of funds, mainly mutual funds. We know them as unit trusts, collective investment schemes, quant funds, risk parity funds. They've got all sorts of different names. But they were caught offside when that spike happened. You saw that spike. When that spike happened, they were caught offside. There was no human intervention there. There's an algorithm that's built into the trading process that says if it goes beyond a certain point, the trigger will just happen. It'll just sell. So what happened was there was another dump of stock, of shares, of positions, into this loop. So this loop was constantly feeding itself, and it was volatility and induced selling. So the question I was asked by this question, the person asked the question about the Middle East is, when is this all over? Because we saw what happened on Monday. It went sky high, and the volatility index and the markets obviously all went plummeting down. We saw on Tuesday things came right. And I think what's happened now is that certainly the volatility index it's about 25, 24 last time I looked on the way home this evening. And I think what's happening is most of those trades have now been unwound. Certainly they'll be unwound by Friday. The only comment that that's the one point, the only comment that the Federal Reserve, Jerome Powell actually said it yesterday. He made no allusions to the fact that we're in a crisis. I personally don't think we're in a crisis. But he made the comment that they would be sticking to their guns, which has been perhaps too dovish and holding on a little bit long, but that the market has factored in probably a 50 basis point reduction in US rates in September, which is about 6 weeks. The meeting's about 6 weeks away. So not too far away. Certainly from a valuation point perspective, a lot of those big tech companies are now starting to say, well, yeah, AI is very expensive. It's costing us a lot. They are adjusting, and obviously the market expectations, there's that expectations again, has actually been a little bit overhyped, and we need to bring things down to a more relative situation. There's a whole lot of anecdotal things I could go on about and tell you about of little interplays that say people were asking why this is happening, why that's happening. But these are probably, if you go and do your own research, these are all being distilled as probably there were root causes that were going on there, but then these were the trigger drivers that really came through on Monday. I certainly feel from the commentators and the sage, if I can use that word, sage commentators at investment banks and brokerages around the world that I interact with, is that this was more of an aberration of an imperfect storm than something that was, we're not in an economic collapse or economic decline. But certainly riskier assets have been caught offside. And it's I think the quality of the companies that one chooses if one's going into the stock market or the type of sectors is absolutely crucial. And I'm still confident that we will have a rate cut, and it's going to certainly benefit quality companies going forward for the balance of this year. We put out a note an email communication earlier in the week or late last week, that we had notes that we are producing. We've had some successful order calls recently in some mining stocks as well as in crypto. And obviously those clients are desperate to get reinvested, to carry on earning. And we just felt it prudent to literally pull back a little bit because we just wanted to see exactly what were the root causes behind this. I think we're more comfortable with the explanations that we've derived, and we're going to hopefully be going forward repricing the opportunities and bring them to market within the next week or so. So I think that's pretty much from it. You know, I was speaking to the chief, believe it or not, the chief executive officer of Goldman Sachs in London Investment Bank on Tuesday. And he said something, I can't remember the exact words, but he was also going to fear. He said, hold your heads, climb the wall of worry, it's all going to be fine. And one of the paraphrases that he said, you know, the short story is that when you are on the backside of a bubble, like we've probably been with all those high valuations, companies that have been dragged along by 7 major companies and nobody else. When you're on the backside of the bubble, so it's becoming a little bit like potentially bursting. And asset managers are deleveraging, as I've explained, the risk in terms of going off the table a little bit. That's not the time that you want to catch a falling knife. And that's what we felt on Monday. It felt like the knife was falling, and do I grab it now and invest while the price is good? I think there's going to be some nibbling in, and you're going to start seeing people buying into positions because there's some good value opportunities. But it's time to watch, follow the smart money, and see where that's going as well. So that in a nutshell is really what happened on Monday. It was it was a big one. It was absolutely big. I think a lot of people were very confused as to the scale and the severity of it. But I think, as you can see, what's happened since Monday, there has been a recalibration, and certainly the right calibration for fear, and the right calibration in terms of some of the earnings and expectations that are coming out of Wall Street. So yeah, on a positive note, I think we went through a good reflective period of not launching our note, sort of hedging it on Friday or Monday. We nearly did it on Friday, and then we saw what happened on Monday, so we decided not to. And I think that's in the opening line of the note that Jill put out was that, we treat our customers like they are family, like what would our family do? And I think that was something that Chad started. He said, we need to always launch a product or produce a product if we're happy our family members would buy. So thanks for that, Chad. And I think that's about it. I think you can, there's lots of info on it.
So Andrew, there's one question. Chad actually put it up there. So somebody obviously asked him. He said, did Buffett's disposal of so much Apple stock also add to the jitters? Why is he sitting on so much cash?
Yeah, that's very interesting. I mean, yeah, it happened almost at the same time. I think the initial reaction was like, oh, Buffett knows something, and that's why he's flogging. But now, why would he only sell one stock? Yeah, that was the question I immediately asked when everyone was saying, oh no, Buffett's out, he's going into cash. He's currently sitting on around about $276 million of cash, which is a massive pile. It's about double that when he started the year. It was one of his biggest holdings in Berkshire Hathaway, his investment company. And he was actually very late to the game with Apple, Chad. He only started investing in Apple in 2016. But if you look at the chart from 2016 on Apple, he's made a bucket of money for his investors in his company, a bucket of money. So the initial was, he knows something, he's sitting on cash, et cetera, et cetera. Now, you need to understand what Buffett's investing style is, its value. If something gets to a too high valuation, he likes to either take the profit or he doesn't believe it's worth that. And Apple was sitting on pretty much an all-time high when he started flogging it. He sold about half of his holdings, so he still got quite a bit there. But it's a lot of cash. And a lot of people look at him as a very sage, wise, and successful investor. There's some other reasons which a lot of people don't drill into. So tax is one of them. Okay, I mentioned he's made a lot of tax. He's going to pay a lot of tax. He's made a lot of money, but tax is one of them because the Securities Exchange Commission in the United States is changing its gains on tax rules this year, irrespective of what happens with who's going to govern the country from November. It's changing that. It's going to have negative implications for him at that point. So that could be one. He wants to lock in gains. As I said, he's made a bucket load of cash for people. So lock in those gains now. And that's pretty much on the back of Apple has been rather disappointing in terms of its trajectory as one of the Magnificent Seven. It hasn't done particularly well this year. It's pinned a heck of a lot. It was late to the party. It's pinned a heck of a lot on its AI app. And if that doesn't work, there's going to be some earnings problems. China is one of its biggest markets, and they've had very disappointing sales of the new iPhones coming, especially iPhones coming out of data coming out of China. So these all kind of tie in to the fact that he's a wise guy. He's made some money. He's exiting the position, and he's repositioning for something else. Somebody. So that's really, I believe, he is sitting tight. Apple could lose its way, and he doesn't want to be burdened with it. So he's locking money and leaving, and there are these tax issues, I believe, that are weighing on him. But if you look also at, it's an opportune time to take the cash. There's an American election. Apple's a US-denominated company, and what will that mean for his own portfolio? If anybody follows him, I can tell you he's been adding some very interesting stocks to his portfolio. One of them being hydrocarbon companies, so companies that mine. He's always been fond of some of the big oil and gas companies, so not renewables but oil and gas. He's got positions in a lot of things, but oil and gas, he loves. Occidental is one of his biggest holdings, and he's recently added to that. So he may be thinking, well, we all know the Republicans are very much let's stay with hydrocarbon, to hell with green gases and global warming. So he may be keeping that as a stockpile, as a war chest for cash, or there may be something else that he's looking at. So that's an interesting question, but I hope I've answered it.
Great. Thanks so much. I think it was quite comprehensive. Are there any other questions? Otherwise, we will wrap it up. Everybody good?
I'd add one more. So, Andrew, given hopefully some of the water's calmed now, in terms of the current thinking of the new notes, perhaps for next week, again, very defensive.
Yeah. So I think that's well pointed out, Chad. So we had a strategic planning session in Johannesburg a few days ago. Well, it's actually a couple of weeks ago. And looking ahead, before this is obviously well before this aberration or sort of big ripple in the water. We looked at some of the narrative coming out of some of those big companies saying growth earnings are not going to be exponential every year. It's probably going to calm down. We have to wait and see if this AI trend does play out and where the benefits flow through to businesses. That's just one sector we looked at. And as a company, as a business, and I think it's well in line with the learnings that we've taken out of this week, especially Monday, is that we need to remain with quality companies, and we have looked in more of a defensive sector. So the sector that we're looking at currently, we were looking at mining, but we switched to a banking sector. The banking sector has been very, very successful for us in the past. Most of our notes have always auto-called early. I think all of them have auto-called early. We've looked specifically at European banks. Simply the pricing is better for European banks. There's not much value left in American banks. They're all quite highly priced. So we look to extract that premium for our investors and therefore get the double-digit return. So we're going to be looking at defensive. We're going to be looking at auto-calling the note with a couple of features we've built in other words, to have it early mature and to get a decent coupon paid out on an income basis. It's going to be an income note paying quarterly returns. But in the defensive space, banks is, a lot of people might think banks are, well, it is quite a dull sort of space. It's not sexy and exciting. You don't see their earnings going up like an NVIDIA or an AMD. But we feel at this point, whilst there's this recalibration, whilst the elections are coming, it's probably time to add conservatism and pragmatism to a portfolio in your own sort of what your rules are in terms of your own investing, your money investing. But we certainly feel because it's been a successful area and that because there's space still in the legs of those particular horses in that sector, being the banks in Europe. And we'll be looking at only tier one banks, A-rated banks, so themselves very, very solid, very dependable, and there's still room for growth there. So that's what we are. Yeah, we're repricing them at the moment because of this movement, and we'll probably be hopefully going to hedge the capacity in terms of the inventory we're going to buy, and then make available to you probably sometime next week.
Perfect. Great. Thanks. Questions? Okay. Available in GBP from Pierre?
Yeah, at the moment it's been hedged in US dollars, Pierre. But we do have a note that came out that's matured in pounds, a different style note completely. There's quite a lot of cash sitting in it. And in fact, we were on a call earlier today, and I said to Chad, it might be worthwhile hedging this or having a price at least in pounds. So that is with the structuring team and the bank at the moment, the issuing bank. So hopefully, I was hoping to get it back before this call today, but we'll probably have it in the morning. But we'll have a look at it, and if there's enough appetite, we'll certainly we'll hedge one in GBP.
Then last one is, in your view, the worse the market, the less attractive the bank borrowing through your organization likelihood may be? Or will that borrowing be necessary to make up for shortfalls? I'm not quite sure. Do you want to just read?
Let me just go to
read
the question.
Read it in the chat yourself.
The worse the market, less efficient. Okay, so maybe this maybe this has got to do with liquidity on the bank side. So effectively, if the bank is flush with cash, which has been the case this year, it's been quite difficult to structure notes with some of the issuing banks, because banks are there to attract money. And obviously, how do they attract it? They offer you some type of return. So when interest rates were really low, if we go back to sort of 2020 through to 2022, 23, interest rates were low, they were going up, but they were really low. So banks were offering a great premium. They were putting a super sort of sexy, fizzy coupon on our notes to attract money. They need money for their balance sheet so they can operate and do other things in terms of what their focus is. So as it's sort of topped out, as the rates topped out last year, plateaued in the States and Europe, and then was put on pause as we all went along the top of the plateau. Banks were attracting money because their deposit rates were their margins were a lot better. So they didn't really have to go out on a limb, if I can call it that, of offering a really attractive or enticing rate. We were finding it difficult to get a reasonable rate. It was all in their favor. They were structuring notes, but it was all in their favor. So we weren't getting a fair shake. As rates go down, obviously their margins reduce, and so coupon levels may go up again. Banks also have to tread quite a fine line, because they don't want interest rates to remain too high for too long. If that happens, the underlying investor or borrower, in this instance, starts taking strain and either goes insolvent or liquidates or something, and the bank's left them with a toxic asset, or an asset that they don't really want to hold. Banks don't want to be landlords. They don't want to be holding great swathes of commercial, industrial, or residential properties, for example. They want to earn interest from people servicing their debt. So they are hoping for this rate decrease. So certainly, if banks are short of cash, they will offer a much better deal for us if they got the appetite. And if they are flush with cash, which they have been, they haven't been super excited to get out of bed and come and chat to us and offer us 12 or 14 or 16% because they're getting it by default anyway. So it has been a little tricky. And it's been probably this year has been one of the more tricky years. The beginning of the year up until probably June has been one of the more tricky years in trying to get a decent coupon out the bank.
So Andrew, we had promised you all 30 minutes, and look at us now.
45.
But I do 45. Okay. But I do want to suggest one thing. I had a wonderful conversation with Susan Ritter, and she's written some really interesting stuff there about utilities, banks, and energy companies. Susan, it'll be wonderful to chat to you, and perhaps you can share some ideas on our next note, and maybe even a Thought Leadership Thursday 1 month if you'd like. Nice to have you on Open Mic.
That would be great. Thank you.
Cool.
Excellent. Great. So I think with that, thank you so much, everybody, for joining us this evening, and have a really, really good weekend coming up for South Africans, the ladies. Happy Women's Day for tomorrow. We've given the guys a holiday, so that'll be great. And for everybody else, thank you so much again. Please do send through suggestions if there are topics that you would like to hear about. Otherwise, look out for the next one.
Thank you.
Cool.
Good night, everyone.
Cool, guys. Nice to see you.
Sure.
Bye.
Bye.
Thanks.